oil prices are trending significantly lower, forecasting cheaper gas and goods due to global oversupply and weak demand. Global oil markets are seeing a significant shift, with prices trending lower and major forecasts pointing to further declines in 2026. This isn't just about abstract market numbers, it's about what you pay at the gas pump and the cost of everything from your groceries to online deliveries. The U.S. Energy Information Administration, or EIA, projects that Brent crude, a key global benchmark, will average around $57.69 a barrel in 2026. That's a considerable drop from its 2025 average of over $69 a barrel, representing a more than 16% decline. This downward pressure comes from a potent combination of factors: the potential for major oil-producing nations to increase their output and a broader cooling in the global economy. For everyday people, this could be welcome news, translating into real savings. But understanding why it's happening reveals the intricate dance between global supply, demand, and geopolitics. To grasp today's oil market, we need to understand its recent volatility. Crude oil prices have seen dramatic swings, from reaching historical highs of nearly $148 a barrel in 2008 to even negative prices during the 2020 pandemic. More recently, after averaging around $69 a barrel in 2025, we're seeing this forecasted decline for 2026. This current trend isn't a sudden shock, but a culmination of building pressures. For the past year, global inventories have been expanding at their fastest pace since 2020, leading to a significant supply surplus. This oversupply has been steadily eroding prices, laying the groundwork for the lower averages we're now expecting. This chart illustrates the forecasted trajectory, showing the anticipated dip in crude prices. One of the biggest pieces of this puzzle is supply. The OPEC Plus group, a collective of major oil-producing nations, including Saudi Arabia and Russia, has decided to keep its production targets unchanged for the first quarter of 2026. They cite seasonally weaker demand as the reason for this pause. However, OPEC Plus retains the flexibility to bring back previously withheld output, meaning more oil could hit the market later this year. Beyond OPEC Plus, non-OPEC suppliers, particularly from countries like Brazil and Guyana, are significantly boosting global output. While U.S. shale production is projected for a slight decline to 13.5 million barrels per day in 2026 from 13.6 million in 2025, it still remains a formidable force in global supply. All these factors contribute to the International Energy Agency's forecast of a significant global oil surplus of around 3.7 to 3.8 million barrels per day in 2026. On the other side of the equation, global demand is also showing signs of weakness. The International Energy Agency, or IEA, recently lowered its forecast for global oil demand growth in 2026, explicitly citing prevailing economic uncertainty. While non-OECD economies, with China leading the charge, are still expected to drive what little growth there is, OECD demand, which includes many developed nations, is actually projected to see a slight decline. This stark contrast paints a picture of a world where industrial efficiency gains and a general slowdown in economic activity are curbing the thirst for oil. The IEA had initially forecast 930,000 barrels per day of demand growth for 2026, but that has now been revised down by 83,000 barrels per day to 850,000 barrels per day. Less demand, coupled with increasing supply, is a clear recipe for lower prices. So, what does this mean for your everyday expenses? The most direct impact is at the gas pump. The EIA anticipates U.S. retail gasoline prices will be lower in 2026 compared to 2025, projecting a significant 6% fall and an estimated 20 cents per gallon decrease. This is largely a direct reflection of declining crude oil prices. For example, in early February 2026, the national average for a gallon of regular gasoline was $2.89, notably lower than the $3.12 average seen a year prior. Beyond the pump, lower crude prices should eventually translate to reduced transportation costs for businesses, which could in turn lead to cheaper goods on store shelves. Less expensive fuel for shipping means lower overhead for manufacturers and retailers, potentially moderating inflationary pressures across a wide range of consumer products. However, it's worth noting that broader supply chain volatility and geopolitical tensions can still influence overall shipping costs even with cheaper crude. Looking ahead, the oil market remains a dynamic landscape. While the underlying forces of potential oversupply and tempered demand suggest lower prices, key events will continue to shape the trajectory. Keep an eye on the upcoming OPEC Plus meetings in March, where major producers will decide whether to resume production hikes. Global economic indicators, particularly from major energy consumers like China, will also be crucial in signaling future demand. This intricate balance means that while relief at the pump and potentially cheaper goods are on the horizon, the interconnectedness of our global economy means we're all watching the pulse of the oil market. The forecasted drop in oil prices for 2026 is a significant development, but the journey of this vital commodity is never without its twists and turns.
This is GeeseFinance.